We know that navigating retirement planning can feel like a shot in the dark sometimes, which is exactly why each week here on 840 KXNT, we turn to financial advisor Jimmy Lin, certified financial planner and founder of Right Path Wealth Management in Henderson. Jimmy, happy Saturday. How we doing?
I'm doing great, Casey. How are you?
I'm doing fantastic. I'm happy it's the weekend, and we have got much to discuss today. But before we dig into it all, Jimmy, I just want to make sure that our listeners know how to reach us. 702-744-8344 is the number to dial. And if you have been questioning whether your retirement plan is truly serving your interests, now is your chance to find out. Jimmy and his team are offering a complimentary retirement consultation to our first 5 callers today. There's no obligation attached to this. This is just an opportunity for you to get answers to those big retirement questions that we know you have. And it's an exclusive offer for our radio listeners. But remember, we've only got a handful of spots. So let's go ahead, get yours secured as we get started here today. 702-744-8344 is that number for you again. One more time, 702-744-8344. Or for more details, you can always reach out online at rightpathwm.com. All right. Jimmy, let's get into it. The Fed is due to meet again over interest rates in mid-September. So that means higher rates for at least another month or so. Here is Mass Mutual's Kelly Kowalski on CNBC. Take a listen.
Higher interest rates for us mean higher earnings, higher reinvestment rates. One trend that we see with the higher interest rates is a lot of annuity sales. And we've just seen, really steady demand for annuities because people seek the relative certainty of return and safety.
So, Jimmy, what are you telling clients who have been on the fence when it comes to buying annuities for that guaranteed income? Talk to us about your thoughts here.
Yeah, Casey, it really seems like annuities are kind of having a moment right now. And because in the past, people have had a bad perspective on how annuities work. They're really complicated. There's a lot of embedded fees that people don't know about. And so I think now with the interest environment the way it is, it's important for people to understand how annuities work. Like, it's not just pick a number out of air as far as how much income an insurance carrier is going to provide for you. A large part of the amount of income that's promised to you when you hand over some money to the carrier for lifetime income based on the interest rate environment. Because what happens on the back end, whether you're trying to get lifetime income or you're just trying to get growth, is that the insurance carrier is taking the money, the premiums that you're putting in, and they're buying long-term bonds with that. Because what happens is if they take some money and put it in long-term bonds, there's a guaranteed amount that they're going to be able to rely on. And by being able to rely on that, they can pass that on to the account owner to create that lifetime income stream. And so when you see the interest rates the way they are currently with the higher interest rates, it means that right now, when you go into an annuity, whether you're looking for, relatively safe growth or you're looking to lock in a guaranteed lifetime stream of income, the amount that the carrier is going to promise to you is based on what they can receive when they're getting those long-term bonds. So interest rates are very, very important. And that's why we're seeing this resurgence. We're seeing people looking into getting lifetime income streams to supplement their Social Security or their pension, or they're looking at, old annuities that they may have had in the past, where because of the change in the interest rate environment, they can do what we call refinancing, right? Just like when interest rates are low, you refinance your mortgage. When interest rates are high, people look at those old annuities that they had, that they signed up for, 3 or 4 years ago, and they can actually refinance those, typically get higher amounts of either crediting or an income stream. So we really encourage people to look at that right now, because you want to take advantage of the current time we have before they start lowering those rates, and you're not going to be able to get the same type of product.
Yeah, right now feels like one of those moments when people are really weighing their options. So let me ask you this, Jimmy, with the Fed's next meeting just around the corner, do you think there's a real sense of urgency here? Should folks who are still on the fence be making those moves now, or is it wiser to wait and see how rates shake out? What's your take on timing in this environment?
No, I do, Casey. I mean, it's just like, how many people do you talk to who have a mortgage and they're telling you, I wish I refinanced my house in 2021 or 2022 when rates were below 3%, right? It's the same situation, is that with the rates high right now, and most people believe that interest rates are going to go down and probably have multiple rate cuts before the end of the year, take a look at your situation and see if it makes sense. Because I'll give you kind of just a generic example. If somebody brought in $100,000 right now and they got themselves an income annuity, we're just making up fake numbers. Let's say they can get $15,000 for the rest of their life every single year. If they took that same $100,000 and said, hey, Jimmy, you know what? A year later, they said, Jimmy, you told me about that annuity, but I'm ready to go now. Well, at that point, if interest rates have been cut, that same $100,000, instead of getting potentially $15,000, they may get $12,000 or $10,000 per year, right? So those are generic numbers, but I'm illustrating the fact that when you take advantage of the higher rates right now, you can potentially get that larger income stream. If you wait a year from now and they've cut rates, then that also means that the potential income that you can get from that same premium amount is very likely going to get reduced. So I do encourage everyone, if they're in a situation where they're nearing retirement and they want to make sure that they have an income plan in place that has their Social Security, potentially a pension, and then they want to create another income stream that you can never outlive, look into that annuity, see if it makes sense to get an income annuity to take advantage of today's rates, or maybe look at just wanting to get safe growth within your annuities as well, within your portfolio. Either way, Casey, that's something that we can help people out with if they're kind of confused about that, or if they want to see where they sit. Reach out to our office. We can schedule a discovery call. We can do it over the phone or through Zoom. But if you reach out to 702-744-8344, you can get on my calendar and we'll look at your situation and see if annuity makes sense and if we can take advantage of these higher interest rates before they go down.
And don't forget, there's absolutely no pressure, no strings attached to this. This is simply an opportunity for you to ask your retirement questions and get those personalized answers from Jimmy. But spots are going to fill up, so make that call now to get on Jimmy's calendar, 702-744-8344. I'll say it again so you don't miss it, 702-744-8344. Or if you prefer online, you can visit anytime, rightpathwm.com. All right, Jimmy, there have been a number of economists who say that we won't see the effects of tariffs until late summer or early fall. Well, here we are. And as Mark Zandi of Moody's explains, he is watching the unemployment numbers very closely. Take a listen.
Once one company in an industry lays off, you tend to see all the other companies in that industry lay off as well. And you can go from no layoffs to a lot of layoffs pretty quickly. Hopefully American consumers hang tough, continue to do their thing, don't pull back, and, we'll avoid that downturn. But if they do pull back even a little bit and businesses respond by laying off, you get into that kind of self-reinforcing vicious cycle called a recession.
So let's talk a little about a recession, Jimmy. What happens during one? How long do they last? And is this something that you are accounting for when you're helping your clients build their retirement plans?
Yeah, the recession, that's the R word that we never like to bring up, but it's a reality, right? So you can't bury your head in the sand. But essentially, just from a practical standpoint, a recession basically means, if the US economy, they have 2 consecutive quarters of decline in the GDP, gross domestic product, then that is considered, from a technical standpoint, a recession. And recessions can last anywhere between 10 to 18 months, historically, is what we see. We've seen that you have these, once a decade, but there's really no rhyme and reason to that. It can happen at any time. But the key thing with that is, when you have a recession, generally what that means is a bear market is coming, where you have some major dips in the market. We're talking about, most bear markets, they technically a 20% loss in the market. On average, they're like 30%, 35% loss in the market is on average what we see. And they can last as long as 10 months. So you definitely have to incorporate that as part of the plan, especially when you kind of read the tea leaves. Part of what that clip said was that a lot of it's based on unemployment. And we can argue whether the unemployment data is accurate or not. But if people believe that there's an issue with employment and, people, the jobs report aren't as positive as we would like, then the market's going to react. So the key thing is that, yes, you build this into a plan, especially when you're nearing retirement. You want to make sure you account for all market conditions, and that includes a recession, which can create a bear market. And that's why we always advocate to have your buckets of money, have those buckets of money that are geared for market performance, keeping up with inflation. But we also like kind of an asset preservation strategy where you put a portion of your money that, you may need in the next, 1 to 10 years, and make sure that that's insulated from market volatility. So if we happen to hit one of those points where the market is going to crash, you're not losing everything. You're protecting or preserving a portion of your assets from the news, from recession, from everything that we hear out there.
It's interesting when people hear recession, I think it can create all sorts of worries, but the reality is not everyone's going to experience a recession in the same way. Some people might still be decades out from retirement while others are right on the doorstep of retirement. So it's going to affect them differently. So with that in mind, Jimmy, does your approach to navigating a recession shift depending on maybe where somebody is in their retirement journey? Would those strategies look different for somebody who's got 30 years to go versus somebody who's just a couple years away?
Yeah, that's a great question. And the answer is yes. I mean, there are no cookie cutter plans. Everybody should have their own custom plan. And a lot of it is based on your stage of life. Kind of like what you described. If somebody's 30 years away from retirement, a recession actually, as crazy as it sounds, can be a good thing for them because the market's coming down. You continue to invest either in the market directly or through your employer plan. When you put money in, you're now buying things at a discount. And so if you have a 30-year time frame before you even need this money, when the market rebounds, not only are your original investments rebounding, but also all those investments that you made while the market was down, you got a discount on that. So you're getting even more growth. Now, we're talking about a different situation with a lot of clients that we work with. Those are the people that are within a few years from retirement or those just entering retirement, because now you have to have a mind shift, right? You're no longer solely focused on trying to get growth from your accounts. Now you're trying to create an income stream from those investments that have grown for you. So at this point, a recession can absolutely change your retirement plans, change the income that you can generate from your portfolio, and then ultimately change the number of vacations you're going to take, the places you're going to go, the way you're going to spoil your grandkids, or even what you leave as an inheritance for your heirs. All of those things can significantly change if you haven't implemented an asset preservation strategy to your portfolio and you are exposed to the market volatility. We see that, 20, 30% drop in the market as you are entering into retirement, and it can really derail all of your plans. So it's really important to understand the stage in life that you're in. And as you're going towards retirement, you want to shift towards looking at how do I preserve my assets? How do I create an income stream I can never outlive? And then how do I take a portion of my assets and allocate that for growth and keeping up with inflation, and then putting all these different pieces together? That's really the key. You want to look at it from a big picture of shifting into retirement and changing your perspective there.
The right retirement strategy is going to blend those different kind of income streams that Jimmy was mentioning to help you through any periods of volatility. So is your retirement plan prepared for a recession? Well, Jimmy and his team want to help you build one that's going to stand strong in any kind of economy. So give us a call, 702-744-8344. And remember, the first 5 callers get on the calendar for that complimentary retirement consultation, and we can see if your plan is recession ready. Again, that phone number, 702-744-8344, or you can visit rightpathwm.com and claim your spot that way. That is going to do it for us this week. We will be back next week, same time, same place, with more great insight from certified financial planner Jimmy Lin here on the Right Path to Retirement. Take care.
Insurance products are offered through the insurance business Right Path Wealth Management. Right Path Wealth Management is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Right Path Wealth Management are not subject to investment advisory requirements. Investing involves risk, including potential loss of principal. Any reference to the protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It's not intended to be used as the sole basis for financial decision, nor should it be construed as advice designed to meet the particular needs of an individual situation. Right Path Wealth Management is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Right Path Wealth Management.
Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations, wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships.